Car payments have spiraled out of control. On average, new car buyers pay around $745 a month, while used car payments average about $521 per month, according to Experian. Interest rates hover near 7% for new cars and spike to around 12% for used ones. Despite these high costs, people keep pushing their monthly payments higher. And the trend of overspending shows no signs of easing up. All my friends have super high car payments. One is $900 a month for a new truck. The other is $800 a month for a Kia SUV sedan hybrid. They make the same as me. Some have kids. I don't get it. Some people don't save money. That's all there is to it. Not saving is the reason why they had to borrow a lot of money for a car. Now they really can't afford to save. They probably say they couldn't save anything before buying it. And maybe that's true. But now with a car payment, they've basically locked themselves out of any chance to catch up. And it doesn't stop there. More often than not, this snowballs into an endless cycle. They borrow for the car, and with those payments, they can't afford to go on vacation, so then they borrow for that. Then the HVAC breaks, so it goes on a credit card. And now they're juggling minimum payments while trying to live like everything's fine. It's not just about the car anymore. It's the ripple effect. A high car payment means less buffer for emergencies, which means the next surprise gets financed, too. And once that becomes the default, it rewires the way you approach money. You stop asking, "Can I afford this?" and start asking, "Can I fit that payment in?" That mindset traps people for years. Every new purchase just digs the hole deeper because they've never had the breathing room to step back, save, and reset. And eventually, the only way out starts to look like refinancing debt, trading in the car they still owe on, or crossing their fingers nothing major goes wrong. And guess what? It almost does. That's why you need an emergency fund. Most Americans describe affordability as "I can make that payment." That one sentence sums up so much of what's wrong with how we think about money. When someone says, "I can afford it," what they usually mean is, "I can squeeze the monthly payment into my budget without overdrafting." Not, "I have the cash," or, "I've weighed the long-term cost." It's completely backwards. Affordability has been redefined, not by financial wisdom, but by marketing departments and lenders. If you qualify for the loan, congratulations, you can afford it. This mindset is exactly why people end up buried in debt while still earning a decent income. Because the focus isn't on the total cost or the opportunity cost. It's just, "Can I cover this month's bill?" It keeps people trapped in a paycheck-to-paycheck cycle where every financial choice is filtered through a narrow window of what their income can handle right now, not what it will cost them over the next 5 to 7 years. In the worst part, this way of thinking feels totally normal. Car dealers, furniture stores, cell phone companies, they all encourage it. Of course they do, right? Sometimes people prefer shorter terms for financing, which results in higher monthly payments. It could be $500 a month for 5 years versus $900 a month for 3 years. Having a higher monthly payment doesn't always indicate someone's spending habit is bad. That's a fair point. In theory, someone could be taking on a higher monthly payment in exchange for a shorter-term loan. And that might actually be a smart move if they're doing it to minimize interest or pay off the debt faster. But when you look at the data, that's usually not what's happening. The average car loan term today is around 66 months or 5.5 years. And for new cars, 6 and 7-year loans are becoming more common, not 3-year loans. It's possible that someone's $900 car payment is just the result of a short, aggressive payoff strategy. But statistically, that's not what's going on. What's more likely is that people are financing increasingly expensive vehicles and still stretching the terms as long as they can just to get the payment down to something manageable. The fact that some are still ending up with $800 to $900 payments despite these longer terms tells you just how far above their budget that vehicle probably is. And again, having a high car payment doesn't necessarily mean someone's being irresponsible. Sometimes people deliberately finance a vehicle they could have paid for in cash to take advantage of exceptionally low interest rates like 1%, 2%, or 3%. But in most cases, long-term loans are used to justify overspending. It indicates they've purchased a car beyond their means and are now stuck with years of financial pressure just to keep driving it. Some people don't realize that the amount the bank approves you for shouldn't be your budget. Just because a bank approves you for a certain amount doesn't mean you should spend anywhere near that number. And car dealerships are counting on people not realizing that. It's shockingly easy to qualify for a car loan, even if your credit isn't great. Dealers have relationships with tons of lenders, and many of them are more than happy to get you into a $45,000 SUV with nothing down and a 7-year loan at 9% interest because it makes them money. The higher the rate and the more you borrow, the more they both make. If you've got a steady income and a halfway decent credit score, you'll almost always be approved for more than you should realistically spend. The bank's only concern is whether you'll likely make the payments, not whether those payments will wreck your budget, kill your savings goals, or eat up your emergency fund. Their metric for affordable isn't based on your financial goals. It's based on their risk and profitability. People walk into the dealership thinking, let's see what I'm approved for, and leave with a car that eats up 20% or more of their monthly income. No real thought is given to the bigger picture: insurance, maintenance, future expenses, or opportunity cost. And because everything is framed around what's the monthly payment, it's easy to get lured into thinking it's manageable, even when it's not. Just because you can finance it doesn't mean you should. Never compare lifestyles unless you're also going to compare credit card statements. That's one of the realest things you can say about modern life. People love to compare lifestyles, cars, vacations, houses, clothes. But almost no one compares how these things are paid for. You see someone driving a new luxury SUV or posting beach pictures every other month and it's easy to feel like they're ahead of you. But what you're not seeing is the $20,000 balance on their credit card, the 84-month car loan, the second mortgage, or the buy now pay later apps stacking up in the background. Lifestyle comparison is meaningless without context. Not to mention the thief of joy. If someone's financing their entire lifestyle with debt, that success is a facade. And yet, that's what social media and even real life often reward. Appearances, not actual financial and mental health. You can't compete with someone who's borrowing their way through life without wrecking your own balance sheet. Don't compare their car to your car unless you're also comparing their interest rate, their minimum payments, their stress levels, and whether they actually own what they're showing off. Real wealth is quiet. Real financial freedom is rarely flaunted. Half-ton trucks are in the $50,000 range to start. Finance that at 72 months around the current APR average of 7% and you're $850 a month if you didn't put money down. $50,000 for a basic half-ton truck isn't even some luxury splurge anymore. That's just the going rate. With those terms, you're absolutely looking at $850 plus per month before insurance, gas, or maintenance. That's mortgage-level money for a lot of homeowners for something that loses value every single day. This isn't just about trucks anymore. The average price of a new car in the US is now creeping up towards $42,000. That means even your typical sedan or crossover, not a flashy sports car or luxury SUV, is carrying a price tag in the mid-40s. Sure, these cars come packed with more features and tech than ever before, raising the standards of what people expect as must-haves. But just because the cars offer more doesn't mean people can actually afford them. We've accepted financial strain as normal. People aren't splurging on outrageously expensive vehicles. They're buying average cars that cost as much as luxury models used to. And they have to have all those features, too. Heated steering wheel, panoramic moonroof, oversized wheels. Owning a brand new basic vehicle has started to feel like a luxury. And for many, the only way to afford it is by taking on major debt. Keeping up with the Joneses, social media has made more and more people become financially irresponsible. Cars have become a major status symbol, and social media has only made it worse. It's not just about getting around anymore. It's about how you look doing it. Keeping up with the Joneses used to be local, but now the pressure is broadcast worldwide 24/7. People show off flashy cars and vacations often financed and not saved for. The fear of falling behind pushes many deeper into debt, trapping them in a cycle of spending just to look good. The worst part, most don't admit the stress or payments behind the scenes, so everyone thinks the lifestyle is normal or necessary. If you're spending around $1,000 per month on your vehicle, let's break that down to what that really means in terms of cost per hour. According to AAA, the average person drives around 1 hour per day, which adds up to roughly 30 hours a month behind the wheel. When you divide that $1,000 monthly expense by those 30 hours, you're effectively paying over $30 per hour just to drive, or $125 per hour every hour of the day, not including gas. $30 per hour is more than many people make at their jobs. It's easy to forget just how much money is tied up in a vehicle until you break it down like this. And it raises the question, is it really worth it? Or could that money be better spent or invested elsewhere? One of the easiest ways to keep from getting in over your head financially is to avoid financing expensive cars that lose value fast. If there's one thing you should really stay away from, it's that keeping your car costs manageable and avoiding long, heavy loans doesn't just protect your budget. It also frees you up to build real wealth instead of just paying for something that's losing value every day.